Hi, I'm Sam Meredith. With the Chinese gross domestic product data released earlier on, we're taking a closer look at how this news affects their economy. As well as this, the International Monetary Fund have made some interesting predictions for the year ahead. So, to discuss these developments, I'm joined by Eric Britton, Director with Fathom Financial Consulting. So Eric, China's GDP grew 7% in the first 3 months of 2015, which is the weakest quarterly expansion since the financial crisis of 2009. However, is this a slowdown for China's economy really a cause for concern?
No, slowdown to 7% is not a cause for concern, and the reason why that's the case is because it's fantasy. The growth rate in China is nothing like 7%. We've put together another measure of the underlying strength of the Chinese economy, which we call our China Momentum Index, which is posting 2.8% growth at the moment for China, and we think that's much closer to the truth. The headline figures are, as it were, let's say, manufactured. They're not real. They're not meaningful about the true position of the Chinese economy. And what we've constructed is this index that puts together rail freight and electricity production and bank lending, the three measures that Premier Li Keqiang drew attention to in some remarks he made to a U.S. diplomat off the record some time ago. So that momentum index is a combination of those three indicators, and for us it's much closer to the truth than 7%. 2.8%, definitely a cause for concern.
The People's Bank of China has twice cut interest rates since November in an attempt to stimulate further growth and investment, but should we then expect even more rate cuts in the short term?
Yeah, I think there'll be further rate cuts. There'll be further stimulus measures too if they do see the same data that we do, and if they make the same judgment based on that, then they'll be very keen to try and prevent the hard landing from turning into something worse, such as a full-blown banking crisis or something like that. And to avoid that outcome, they'll put all the stimulus measures they can in place. But the one that they really need to put in place, which they'll delay as long as they possibly can, is to allow the renminbi to fall in value, not by a few percent, but by maybe 20, 25%, something like that. We feel that the pinch point that'll force their hand in that is when the Fed starts to hike rates, which we're looking at September this year or thereabouts for the hiking phase to start in the US. And given that the renminbi is pegged to the dollar, that's going to put further upward pressure on the dollar, make it more difficult for the Chinese authorities to defend that level of the exchange rate. And that's the point at which we think they'll let the renminbi fall, or even cause it to fall. And that will help their competitiveness, it'll help net trade, and so on and so forth. But if you think you've seen China exporting deflation to the rest of the world over the last 10 years, you've seen nothing compared to what's going to come in that eventuality over the coming 5 to 10 years. So there's problems for countries who are threatened by deflation, vulnerable to deflation right now in that eventuality, even though it's one of the measures that might help China recover somewhat later on in the year.
Lastly for today, the IMF World Economic Outlook has predicted that India's economic growth is likely to outpace that of China's this year. How has this been possible, and is India's growth rate sustainable?
All developing and emerging economies tend to post higher growth rates than developed economies do on average, and also tend to be more volatile, susceptible to inflows and outflows of capital, that kind of thing, and that applies to India just as much as it does to China and to other countries. That said, I agree with the IMF that India is likely to outperform China in truth this year, even if not in the headline figures, and not just this year, but in subsequent years too. And the reason for that is that China's growth model has been predicated the last 10 years and more on ever-expanding external markets for Chinese exports, particularly of manufactured goods. So investment within China geared at boosting the capacity of China's manufacturing industry with a view to developed economies around the world hoovering up those exports with an infinitely large appetite. And that growth model basically stopped functioning around the time of the Great Recession that started in 2008, 2009. And in our view, there's not much prospect that it's going to start giving in the same way that it did in the decade ahead of that recession over the coming few years either. All right, the US is doing okay, but other developed economies are in a very bad way and likely to remain that way for several years to come. India, by contrast, was not geared around ever increasing exports to developing economies. Instead, it had and still has a strong domestic economy founded on growth in income there and growth in productivity as well. And that stands it in much better stead in the new world that we're all facing after the Great Recession. People who rely for demand from developed economies for their growth are going to struggle, whereas people who rely on their own domestic demand will do much better. And India wins vis-a-vis China in that respect. So in our view, the prospects for the medium to long term are probably better in India than they are in China.
Thank you, Eric. Check back with Dukascopy for more updates throughout the week. Goodbye for now.